Buyers are always mystified about what the difference is between private mortgage insurance and putting 20% down. So today we're going to demystify kind of the nuances of what a private mortgage insurance is, also called PMI and sometimes here called MI. And Dan Golden with Cornerstone Lending, he's here again with us today so we can go over some of the costs, the different options to consider, tax benefits versus non-tax, and which loans are really the best to consider. So with that, my name is George Moorhead with Bentley Properties. And again, we've been practicing over 25 years. I think that's safe for you too, isn't it? Yep, there we go. So between the two of us, we've got loads and loads of great information for you. If you have any questions, make sure you post them up in the upper right-hand corner. You can send me a text, an email. You can leave it up on the message board. We'll have Dan's information so that you can also contact and reach out to Dan direct, which is teamgolden.com. All right, www.team and then golden.com. All right, so with that, Dan, let's talk a little bit about this. Okay. Private mortgage insurance, why does it even exist? What is it for?
So private mortgage insurance is insurance for the lender. It does not really provide a buyer any benefit, but it's required when you put less than 20% down. So it's insurance for the lender that the buyer pays for.
Okay, so it has nothing to do with the buyer at all.
Well, it does, but it's required on the loan. The buyer pays for it. That's what it has to do with the buyer. So
okay.
That part, yes.
But the benefit is for the lender.
That's right.
Okay. It's that security that in the event that the buyer defaults, then we move into the private mortgage insurance, which protects the lender.
Protect a portion of those lost to the lender if they have to.
Okay. Is this a Fannie Mae, Freddie Mac, HUD guideline?
It's pretty much all types of loans require it if you have less than 20% down, with the exception of a couple that we'll talk about.
Mm-hmm.
But it's pretty much industry-wide. It's not really specific to Fannie, Freddie. It's every lender out. That's why it's called private mortgage insurance.
Okay.
So that's the reason it's private. It's insurance. It's like buying homeowners insurance on your house.
Oh, okay.
It's insurance on your mortgage that benefits the lender or
perfect.
the investor.
Okay.
Yeah.
Well, that makes perfect sense, right?
Yeah.
Okay. Well, let's go through. So some people call it PMI, right, which is a acronym, or MI, because we like to get things shorter and shorter and shorter, right? Okay. So there's two different kinds. We have conventional and we have FHA. All right. Here you've got written down forever.
Right.
Now, forever is a really long time because it's forever.
Right.
All right. Why do we have this as forever?
So FHA, it's just a requirement of FHA. And I don't really know exactly why that is, but they require it for the life of the loan. And conventional, there are ways to remove it after a period of time. So again, FHA has a lot of benefits to it.
Okay.
So if you have to go FHA, there's some good reasons to go FHA. But to remove that mortgage insurance or to eliminate it down the road after you've owned the home for a while,
okay,
you're going to have to refinance the loan into a conventional loan.
Oh.
On a conventional loan, there are ways to remove it without refinancing.
Oh, really?
Down the road, yes.
Okay. Now, is that based on like loan to value? Is that based on time?
Both.
Okay.
So there's a lot of different ways to remove your mortgage insurance if
okay.
you have a conventional loan. First of all, you can wait for 2 years. And if your equity goes up to 25% equity of the property, call your lender and say, please remove my mortgage insurance. They'll come out, do an appraisal, verify the value, drop the mortgage insurance.
Okay, so to be clear, that's one way. So let's make that even a little bit simpler. I put 5% down. I got a $700,000 loan. I put 5% down, and let's say in 2 years, yep. I now have 30% equity, or what we call a 70% LTV, loan to value. Exactly. At that point, then I can apply to have that removed.
You can call the lender. They'll do an appraisal, verify the value, drop the mortgage insurance.
That's pretty good.
Yeah. So it's a temporary payment on the conventional loan.
Okay.
There's another way you can do it. Some people will put 5% down. They get a big bonus 2 years later. They write a check to 20% of normally 20% of the loan they had in the beginning. So it has to go back to the original value.
Okay.
You can't use new value. You pay it down to 80% LTV.
Okay.
And then it just gets removed.
Is there a time limitation?
On that one, there's not a time limit.
Well, that's actually good.
2 months later if you want
Okay, so different question then. We talk about mortgage insurance here. What in a buyer's mind, what would normally buyers consider? Why would they choose maybe one of these four options that we're going to go into in a little bit?
There's a lot of different reasons. It's going to be client specific, but a lot of it has to do with their specific needs. You know, are they going to have a chunk of money that they bring to the table at some point within a couple of years or a year? That might help them. Are they going to be able to pay down their mortgage? Do we think their value will go up quickly within 2 years?
Okay.
That's another reason. Are they concerned about tax benefits? Are they limited on funds to close?
Good question, right?
Or do they have some extra funds to close that they can apply? There are some reasons to use those additional funds. Do they have a seller that might be willing to pay out to basically buy out the mortgage insurance? So there's a lot of different scenarios that we could talk about.
Okay, perfect. But that's a one-on-one, take a look at the big picture with each specific buyer. It's not just generic, it's very specific.
Yeah,
exactly. Okay, and you know what, that makes perfect sense. Now, we've got over here, we've got this little note, VA and some jumbo. What does that mean?
So we were talking about conventional, we were talking about FHA. There's also jumbo loans, which are loans in our area that are over 726.
Okay.
They're going to go up in January to around 750-ish. Those are jumbo loans, and there are some jumbo loans that do not have mortgage insurance required on them. They typically require 10 to 15% down, but they don't have mortgage insurance, which is nice. And also VA does not require mortgage insurance at all. Not all jumbo loans are mortgage insurance free, but there are some out there, and we have a lot of options I can show people.
Actually, that would be great because in January, our mortgage lending rates are going up to 742, 741.
Loan limits are going in the 750 range, 751, I think, in our area.
$751,000.
Right. That's the loan size, maximum loan size. King Pearson's now.
So what makes a jumbo then?
Over that amount would be considered a jumbo loan.
A loan amount.
A loan size.
Okay, so that's after they put their down payment down. That is the amount that they have left over that they're physically financing.
They did an $800,000 purchase with $50,000 down. They are not a jumbo loan.
Okay, that's really good feedback. Okay, and they can contact you. This is an ongoing program. Is this a short-term program?
No, they're always available.
Perfect. Hey, there you go, guys. For those of you looking at higher amounts and don't want to put 20% down, you got to call Dan about this program. That is, I didn't know that. That is absolutely awesome. Okay, so let's talk about the different kinds of mortgage insurance type of options. And let's denote, we see there's no tax benefit for a couple of them, and there's one that has a tax benefit. Take us through these, Dan. So let's go with the monthly.
Okay, so again, these are going to be specific to every client. We'll talk about that on a one-to-one basis, but there's monthly mortgage insurance, which is going to be a monthly cost every month, and we're going to show you the breakdown of all that in a minute. But it's a monthly cost you pay every month, and until you remove it from what we talked about before, value goes up or you pay down your loan, that monthly payment will be on your mortgage, added to your mortgage every month until you have it removed.
Okay.
FHA, again, it will never be removed unless you refinance.
Okay.
Financed is where you can pay a one-time premium on your mortgage to buy out the mortgage insurance, which is the one time here. But you can also you can pay it. You can pay it as a chunk, write a check for it.
Okay.
Or you can have it financed in. So you can finance that premium, pay it off. You'll never have mortgage insurance ever again. One-time payment, or you can write a check for that. You can either finance it or write a check for it.
Okay, and then we have a lender paid. I like this one.
This is a good one. If there are some reasons to do it and not do it again, but lender paid finance, lender paid MI is where the lender pays it for you in lieu of a slightly higher interest rate. And one thing to understand about mortgage insurance, it is not tax deductible. No mortgage insurance is tax deductible. But if you pay a slightly higher interest rate, the interest is tax deductible. So you're eliminating the mortgage insurance, trading it off for higher interest.
Okay.
That's tax deductible. And when you see the payments, you'll see the payments are actually lower in this scenario.
Which you wouldn't think that would be the case. Most people are so interest rate sensitive, right? Because everybody's, I want the best rate, I want the best rate. And what you're saying is that this is not the case.
Correct.
Okay, so what we did is on the reverse side, we took this $700,000 home And we are actually breaking it down into the payment amount, and then we go into the different options of mortgage insurance. So let's pop over there real quick. All right, we'll use our magic board. All right, so here we go. So we have $700,000 purchase. We're doing a 5% down with par pricing today was 3.75. Okay, so our payment, that's the principal and interest only, was $2,492, 30-year fixed. Okay. This was taxes, property taxes at $580. Homeowners insurance was $125 a month for a total cost of $3,197 for a payment. Now, here's the thing. Now we talk about, because we're putting less than 20% down, now we're talking about the difference of 15% in this case. So now we are bringing in our mortgage insurance costs. So let's go through these, Dan. So we have our monthly.
So let me make sure, I want to make something really clear, because I get this question a lot.
Okay.
When I say what homeowners insurance is.
Right.
This is home insurance on the house if it burns down and you have to have it rebuilt.
Okay.
That's what this is. This is not, has nothing to do with mortgage insurance. People get the mortgage insurance and homeowners insurance.
This is like car insurance for your house.
Exactly. And this
Perfect.
does benefit the buyer.
Okay.
Okay, so monthly mortgage insurance is, we talked about that before. In this scenario, for 5% down, it's around $277 a month.
You're right. This was the most expensive.
Right.
Wow.
But it's removed. The cool thing about this, though, is it's removable. You're not going to have it forever.
If it's conventional.
If it's conventional.
Okay.
Right.
Right.
So if you finance it in, it's going to be a lower, that one-time premium of $11,000. Let's skip ahead here. The one-time cost, if you were to buy this out, where you never have to pay the $277, you never have mortgage insurance ever again, is for this scenario is around $11,000.
Okay.
That can be, you can write a check for that. The seller can do that, can pay for that, or you can finance it in. You can add it to your loan, and it makes your payment about $127 higher in payment.
Okay.
So that's a good option, but it looks like a lot lower payment, but you're adding this to your balance of your loan. So you're going to owe more on your loan at that point.
So just rough, okay, because we didn't talk about this, just kind of off the cuff. This looks roughly about 5 years of repayment time.
Yeah.
5, 6 years, somewhere in there, plus or minus, right? Okay, so just to give somebody an idea, somewhere around the 5, could be a little less, a little more. Again, just off the cuff, right? If they're going to keep the property less than 5 years, this probably may not be a good option for them. Is that right?
I just calculated in my head. It's around 8 or 9 years.
It's 8 or 9 years. See, my math is spot on. Yeah. So anyway, so okay. So if they're going to keep this less than, let's say they say, hey, I'm going to do an ARM for 5 or 7 years, this may not be a really good option for them.
And that's part of that question Q&A I'm going to do with the client when they call me and ask you how long they're going to be in the house. If they're going to be there forever, this is not a bad option.
Right.
If they're going to be there 10 years, not a bad option.
Right.
Anything less than 7 or 8, probably not the best.
Probably not the best. Okay. This one here, lender paid, shows at 181. Now you're indicating that this was the best option because there's tax benefit. Okay.
So this is, you're taking a rate of, instead of the 3.75, you'd be like in the 4.125 range. So it doesn't sound great. Doesn't sound as good as 3.75, right?
Right.
But you're eliminating that. You're eliminating this essentially, and the interest rate increase that you'll see this payment go up is around $181. So it's actually a lower overall payment. You're not adding more to your loan.
Right.
It's a good option. Here's the downside of it. That rate stays there forever. You're never going to have a lower rate.
Unless you refinance.
So again, this goes back to